Hello friends, welcome to CEC Live Lectures. Dear friends, today in this session, we are once again going to talk in our series on financial accounting. In our previous session, we discussed on final accounts and specifically, we made you aware about the horizontal presentation. Friends, as promised that we are going to talk on vertical presentation too. So here we are to discuss with you more and more on vertical presentation. And for the discussion of the topic, we have with us in our studios Dr. Amarjeet Kaur. Dr. Amarjeet Kaur is a professor of accounting and she is teaching in one of the leading institutions of the country. Dr. Amarjeet Kaur is a prolific professor. Her dynamism could be seen through her work, through her knowledge also, and friends, she is an author of numerous books on accounting. She is a certified management accountant from USA, and continuously and persistently she makes efforts so that the student community is benefited as a whole. Through the live platform of CEC, she always benefits you through her knowledge. Friends, if you wish to ask questions from Dr. Amarjeet Kaur on today's topic, then you are requested to call us. In order to contact us, call us, you need to dial our toll-free number. Our toll-free number is 1-800-110-430. I repeat, our number is 1-800-110-430. Dear friends, you are requested to call in the last 10 minutes of the lecture only, so that first you could have deep insight into today's session. Now, I would like to welcome our guest, Dr. Amarjeet Kaur, once again. Hello, ma'am. Welcome.
Hello, Kritika. Thank you very much. Good morning, viewers, and welcome on this lecture on vertical presentation of final accounts. We shall be targeting on discussing the how to present information in balance sheet, all the heads of the balance sheet under vertical presentation, and then we will take up a case. So we will be going into details of all the heads pertaining to balance sheet under vertical presentation. So as per revised schedule in Indian context, we have a vertical schedule available, vertical presentation of items available on the website of Institute of Chartered Accountants of India. You may like to refer that site and can get into details. Nevertheless, we are going to discuss in detail here itself. So friends, as we know, in vertical presentation, items goes one after the another, and we do not have a T shape or a regular balance sheet as we generally make for proprietors or partnership firms. In vertical presentation, the information would be line by line, right? So in this regard, I would like you to begin with having a look at the balance sheet format. And after we discuss the format, after showing you up the format, the next thing is that I would be getting into details of each item I show you in the format. So this is how we would proceed for the first half today. So let's have a look at the balance sheet format, which has been given as per the revised schedule here, and is very much readily available on Institute of Chartered Accountant of India's website, right? So let's have a look at the slide, please. This slide shows you, and the title goes like this: the format of balance sheet. If you look at the top, it says format of balance sheet and balance sheet of a company XYZ. So as I said in my previous lecture, it is not mandatory for a proprietorship firm or a partnership firm to follow vertical presentation, whereas for companies it is mandatory to follow only the vertical presentation of final accounts. So that's why the name here I have denoted it as a company, that the business is here company. So as on 31st March, or it could be 31st December, it could be any other day as well, right? So first of all, this title is there. Then if you look at the column, we have three columns: particulars, note and amount. The column in the middle, note, is now very important. Generally it was not there in the past. So we are required to in fact show all the details of our calculations, our working, and they need to be numbered. Those working needs to be numbered, and that number where we have calculated the value of a particular head should be written in this column, which is called as note column. So it's very important to keep in mind that this column has gained a lot of importance after this vertical presentation being introduced, right? So having said that, let's go to the details. In balance sheet, as we know, we have only two sides, primarily asset side and liability side. So the liability side has been named as equity and liabilities. So the heading of the beginning of this vertical presentation is from equity and liability side. So we do not begin with assets, we do begin with equity and liabilities. So equity and liability becomes the title of this side of the balance sheet. Of course, no, it's not going to be side, or it's going to be in running format, and it would have 4 subparts in it. Now those 4 subparts are share capital allotment, money pending. The third would be non-current liabilities, and fourth would be current liabilities. So we are required to present these 4 heads in this order only, in the order I just stated, right? So these are the basic things I am referring, because the beginners, all those people who have to follow it for the first time, it's important to understand the order and the format. I know it's those people who have learned only the T-shape or horizontal presentation, they really find difficulty to adopt this new one, because here then in that case the person need to unlearn what he or she learned earlier, and it's very difficult, this is challenging for our mind to unlearn something which we have learned very well and then to relearn. So I have seen my students even at my MBA class and other classes that even they faced problem when I introduced, because about 50% class or more than that was from commerce background, and so people who were non-commerce backgrounds, who were engineers or doctors, they found it easy because they have never learned the T-shape or horizontal presentation. But the ones who were from either commerce background or management background, they actually struggle hard because they needed to unlearn first and then relearn. So that's why I am saying, if you are the beginner, you are doing it for the first time, learning it for the first time, it won't be difficult for you to adopt the vertical presentation. But people like me, even who have been practicing accounting from the last 25 years, even this was difficult for me when this particular format came a couple of years ago, just recently in the past. So it would be same for you as well. So now after this, let's have a look at the items, the sub items under those 4 heads which I just mentioned. So beginning with the share capital, let's have a look at the slide, please. Here the title goes like this: equity and liabilities. Kindly follow my cursor, I will be pointing out while discussing. Under that, the first head, number 1, is shareholders fund. Here share capital and reserve and surpluses and money received against share warrants. There are 3 subheads. So shareholder fund is a wider term. It has share capital. Mind you that we need to show preferred and equity share capital separately. We cannot club them together. So under share capital you may have 2 heads, right, depending upon which particular type of share capital you are using. So share capital, after that we have to show the reserve and surplus. Whatever the amount of reserves we have created out of our profits, they are going to be shown here. We will get into details after a few minutes. Then the money received against any share warrants. Share warrants are generally issued to employees. So if anything is being received, that is going to be shown separately under this head, but mind you, not in the amount column. So this particular bracket, this particular note, not to be evaluated, is very important. It means this head is going to be there, but this value is not going to be added up in the total amount of equity and liabilities, right? So number 2, we have share application money pending allotment. So those application monies which have been received, but we have yet to allot shares to the applicants, that needed to be shown separately. And since we have not, money has been received, right? It is with us, it is in our bank account, but we cannot show it as our share capital. But then the question is, we have cash, so how to deal with it? So requirement is that we should be showing it under share capital allotment money, allotment pending, and amount should not be added in the total value of equity and liabilities. The third is non-current liabilities, and under the non-current liabilities, if you observe, the important is that order is in permanency 1. As we discussed in the past, that the order of showing assets or liabilities could be either in permanent order or it could be on order of liquidity. Here, the final outcome of the revised schedule in vertical format of a balance sheet is this, that we shall be following only the this permanency order. So liquidity order is out of concern and discussion here, especially for this vertical presentation. Nevertheless, the same can be opted if you are a proprietor or a partnership firm and you are opting T-shape account or you are opting horizontal account, right? So horizontal presentation doesn't stops you presenting in liquidity order or in permanency order, whereas this particular format where we are using vertical presentation for our balance sheet, we are required to follow only permanency order, right? So we have a couple of items. Let's have a look at the slide. Under non-current liabilities, the first item we have is long-term borrowings. We will discuss what all fall under this head. The second is deferred tax liability, and again the third column says not to be evaluated. So deferred tax liability is basically something which has happened because of the difference on in keeping the books of accounts as per accounting procedure and the other set of accounts as per tax laws. So both of the books would show a different tax liability, and that particular difference, which is simply because there are two different accounting system being in place in an organization. One accounting system is showing a different value of profits, because here we are guided by accounting guidelines, accounting standards have been followed, and another books of accounts are showing a different amount of tax liability, and that is because the taxation law requires you to present information, charge tax on assets or charge depreciation in a different way. So two different values of profits are there, or tax liabilities are there. So that amount which is in difference, which is not in consensus with each other, that the difference is shown as deferred tax liability, and that particular amount would be shown, that head is going to be shown here. But as I said, this amount would not be added in the total value of liabilities and equity section, right? Then the third part of this particular head is other long-term liabilities. Other long-term liabilities are many, we will discuss in detail after few minutes. The fourth head is current liabilities, and here again the current liabilities would be shown in the order of most permanent to the least permanent, and the most permanent would be short-term borrowings, followed by trade payables, and then we have other current liabilities, and the last would be short-term provisions. So if we add up 1, 2, 3, 4, right? If you see at the last row here, so total would be actually sum of the first, second, third and the fourth heads. So this would be basically our first part, equity and liability section. Now the second section I am going to talk about assets. Now the second section is assets, and assets, have a look at the slide, would have two major parts. One would be non-current assets and another would be current assets, right? So, non-current assets have 4 sections in it: fixed assets, non-current investments, long-term loans and advances, other non-current assets. So, fixed assets have 2 subsections. One is tangible assets and another is intangible assets. So, tangible assets, all those items which we can see, either it is furniture, table, plant, machinery, etc., they would be shown here, and intangible assets needed to be shown separately, and there are many heads under this. I will show you in a separate slide a few minutes from now. Then the non-current investments, investments by company in the shares of other companies, in debentures of other companies, is a long-term investment and non-current in nature, that should be shown under this head. Then we have long-term loans and advances. So, if we have invested in, if we have extended some loan or some advance to someone, either to employees advances are given or loans are given to somebody. So, that is our non-current assets. If it is for long term, for more than 1 year, that would be falling under this head. Part D is other non-current assets. Anything which has not been covered so far falls under other non-current assets. So, basically this section deals with only those assets which have a life for more than a year, right. The second section is of current assets, and under this section we shall be showing those assets. And mind you, ICAI guidelines expects you to actually follow the same order of items as given in the format. This is very important. It means you need to memorize the order. So, under current assets, if the permanency order goes, and we start with current investments, followed by current inventories, then followed by your receivables, followed by cash and equivalents, then short term loans and advances, and the last item would be other current assets. So, other non-current assets were there in the first section, and other current assets are there in the second section. So, loan and advances were there in both the sections. So, I would request you to kindly note down or kindly register this fact in your mind, that these other current assets and other assets could be other current assets and other non-current assets. If it is other non-current assets, they fall under the first part of the asset side, and if they are other current assets, they fall under the second section of asset side. And same is true for loans and advances. Loan and advances could be long term, could be short term. So, if they are long term, means if they have a life of more than a year, then they would fall under the first section, and if they have a life of less than a year, then they would fall under the second section of asset side. So, these small tips would help you to memorize, to understand this vertical presentation well, and I am sure for many of you, especially in India, this is for for the first time that you are learning this vertical presentation. So, after this format shown to you for balance sheet, I have not covered profit and loss account, and I do not intend to actually in this lecture today. That shall be covered in the next following lecture. So, after covering up the items given in format, let's get into details now. I shall be talking about some explanation now. So, here is a slide showing you shareholder fund. Kindly have a look at the slide. This is showing you the first item is share capital. So, the share capital, a note has been shown to you. Note says equity share capital and preference share capital are to be shown separately. So, this is very much as been given on the website of Institute of Chartered Accountants of India. So, part B, reserve and surpluses. So, the following item, let us now get into detail. The following items are shown under this head. What are those items? Capital reserve, so any reserve created out of capital redemption reserve to redeem preference share capital. If any reserve has been created, that particular reserve would be known as capital redemption reserve. Securities premium. So, if we have issued share on premium, then we need to show it separately, but that would be forming part of shareholders fund only, right. So, under reserve and surpluses. So, shareholder fund has share capital, reserve and surpluses, and other items, as we will be showing you now. So, then we have securities premium followed by debenture redemption reserve. So, if company has kept some money aside out of the profits, of course, to redeem debentures which are going to be becoming due or mature in future, that is going to be shown here in a separate head. Then revaluation reserve. So, this bracket is very important. Revaluation reserve is basically when we revalue our non-current assets. Current assets are not subject to revaluation. So, revaluation means when we actually assess the current market or the fair value of the non-current asset, and if we find this is different, it is more or less, then we are going to get a difference of the previous value shown in our balance sheet and the current fair value. So, the difference is known as revaluation surplus if the value as of date is more. So, that needed to be shown under this head, but mind you, we do not add this value into the total value of assets. That is why this bracket becomes very important. Alright. So, followed by the next thing would be share options if they are given to employees and we have some outstanding amount. So, again this amount will not be evaluated. Then we have other reserves, but now it's important to understand the latest development, and latest development is this, that now we do not have many reserves acceptable by the agencies to be shown in the books. It is only the journal reserves which can be actually kept, and we can show it as a separate head in our books of accounts. So, not many reserves are now allowed than the journal reserve. So, this is the latest development, should be apprised to you. Then we have a surplus. Now, surplus, this particular head needs your attention. I have seen people getting confused while preparing final accounts. If profit and loss account title is been given with some suffix saying debit or credit, people get confused. I have especially students, So, credit balance of profit and loss account means profit, right. So, credit side of profit and loss side being higher means your revenue is higher, and that leads to profits. So, if it is credit side, if it is being given profit and loss account balance and in bracket it says credit, means we are talking about profits, and if it says debit, that means we are talking about losses. So, either it is a credit balance or it is a debit balance, we have to adjust this value from shareholders fund only, right. And because of this, there is a possibility, there could be a situation, not very normal, but this is quite possible, that a company has very heavy amount of losses, and if we adjust it against our capital, it exceeds, though very rare, but it is quite possible. It means a company may have a negative value in shareholders fund. I would repeat, yes, I am saying if profit and loss account has debit balance, and so much so that amount exceeds the total shareholder fund, for other heads we have already calculated more than that, then it would lead to negative value. So, it means you should not be surprised if some question comes to you that can we have, can a business have negative capital? Yes, a business can have negative capital, right. So, this was something important to emphasize at, and that's what I did. Let's move forward. The last item in this shareholders fund is money received against share warrant. So money received under share warrants, again we need to show it separately, but we are not going to add up. Now let's go to the second head, non-current liabilities. Under non-current liabilities, we are going to show first long-term borrowings, which could be debentures, bonds, bank loans, long-term loans, mortgage, public deposit, etc. Deferred tax liabilities, as I already discussed, the difference is shown, but it is not to be evaluated. C part says other long-term liabilities, and then that other long-term liabilities accounting treatment is that it is not to be evaluated if it is some intercompany, it transaction pertains to associates or your some company which is parent and subsidiary, some dealing between parent and a subsidiary company. So that needed to be excluded in the value. And the last is here long-term provisions. Long-term provision may include provision for employee welfare, provisions for benevolent fund, provident fund, gratuity fund, all those heads, right. So this is the non-current liability. So so under this head in the section left hand side, assets, the last item is current liabilities, and as I said, current liability would include first of all your short-term investments made in treasury bills of government, CDs. So such thing which is less than a year, generally Government of India would issue 90 days treasury bills. So those items would be taken here, followed by your trade payables, payables like sundry creditors, bills payables, outstanding expenses. Sorry, we have to take short-term borrowings, not short-term investments in the liabilities. Other current liabilities would be unpaid dividend, interest accrued and due but not being paid, income received in advance, calls in advance, outstanding interest and outstanding interest on calls in advance. So these are the items which would be taken under current liabilities. And the last thing would be provision for taxations. So provisions which have been created for taxations or dividends would be shown separately, and if it is dividend has already been declared in the during the year, it could be interim dividend but it has not been paid yet, that would be shown separately under other liabilities. So mind you, it's important to differentiate between these two things, that dividend has been announced and not paid is going to go into the current liability immediately to be paid, whereas provisions are going to be shown separately as a last head under this category of current liabilities. So with this we have covered one part of the balance sheet in detail. When it comes to explanation, very shortly we shall be discussing the second half of the balance sheet, where we shall be discussing assets, and thereafter we will take a case on vertical presentation. Hope you were able to understand, because we have covered quite a new concept, a latest one, and there were a couple of new things which probably have not been discussed before here. Thank you very much.
With this, thank you, thank you very much for giving us this session. Friends, there is a lot more for you in store, so you are requested to be with us as we are back after a short break. Thank you.
Thank you.
Hello friends, welcome back to this session. Friends, as you know that today we are talking on vertical presentation, and so far we have discussed a lot, and as promised that we are going to give you more and more of knowledge. So here we are for you once again. Friends, for the discussion on the topic, we have with us in our studios Dr. Amarjeet Kaur. Dr. Amarjeet Kaur is a professor of accounting, a dynamic professor who always believes in giving her best to you, and you are always benefited through her, as we could find out from your feedback. Friends, we would like to welcome our guest Dr. Amarjeet Kaur once again and would request her to continue the lecture further. Hello ma'am, welcome back to the session.
Thank you, Geetika. Thank you very much. Welcome back, viewers. We shall be continuing with the vertical presentations as we were doing in the first half. We have so far covered the first part of the balance sheet, where we discussed about equity and liability sections. And all those viewers who have joined us now, I just want to brief that it's very important to have understanding of vertical presentation, because that is going to be the order now. And if you have missed it, kindly follow us in our YouTube presentation. This would be available on YouTube in very shortly. So let's now go into details of the second part of the balance sheet, which is asset side, and here we will be going for explanation of items covered in vertical presentation. The first first item is fixed assets, and as we know, fixed assets comprises plant and machinery, furniture, fixtures. All those items needed to be shown separately. First in notes, and then the total value should be shown as one item. So we do not show them separately in the balance sheet. Our notes could be independent. Our calculation of depreciation pertaining to each of the fixed asset could be there. We may have separate note, but when it comes to showing the value, we are going to show it all together in a consolidated value. This is important. And the note number should be referred in the format itself. Another important thing is that as per this vertical format requirement, or the revised schedule, in fact, we are supposed to be showing intangible assets separately. And now the intangible assets are not limited to patents or copyrights. There are so many developments, especially the technological developments, and there are many intangible assets which have came into picture, which our business uses and refers to. So I am going to give you an elaborative list here on the slide, so that you could correlate, and they all are quite relevant and the latest things. So have a look at the slide. It says, initially goodwill, brand, trademarks, so they all are known examples of intangible assets. Other than that, we have computer softwares, mining rights, masthead and publishing titles, copyrights, patents, intellectual property rights, services and operating rights, recipes, formulas, models, designs, prototypes, licenses and franchises, right? So there are so many things to be taken under intangible assets. So whatever number of intangible asset a company is using, they need to put them separately in notes, and then club them together and show as a one value under intangible asset. Then we have capital work in process. We need to show it separately if any long term asset is under construction, but the value will not be added in the total of the assets. Then we have intangible asset, all those intangible assets under development. It's not that intangible assets are ready. There could be a possibility that some kind of patent is under development. So we should not be showing the value, but we would be showing it as an item. So this value of those intangible assets which are under preparation, under development, the amount will not be added into the total assets. After that, we would have non-current investments. So non-current investment means investments made in the shares, debentures of other companies. So investments which are for long term period, which are for more than 1 year, they are known as long term investments. So they would be shown here as a separate head. So they needed to be segregated, and mind you, non-current investment and short-term investments are again segregated. As we discussed in the liability section, same thing is applicable in assets section. So it means here in this part, first part of assets, where we are showing non-current assets, we are going to show it separately, right, and the current investments would be shown under the current assets only, second part. Now next thing is deferred tax assets. As we have shown deferred tax liabilities, we are going to show deferred tax assets as well, but value will not be added in the assets. And then we have long term loans and advances. If we have given loan to somebody outsider, some associate, some kind of business, some kind of client, and advances given to employees, they are going to be shown separately. Then we have other non-current assets. Other non-current would comprise what? So if you look at the slide, it shows preliminary expenses, discount on issue of shares, discount on issue of debentures, underwriting commissions, deferred revenue expenses, discount on issue of shares, debentures, share expenses. They all are basically to be shown separately as other non-current assets. So basically these all items beginning from preliminary expenses, they all are going to be shown as other non-current assets. Now let's have a look at current assets. So the current assets have 4 heads in it. First is current investment. Current investment means investment in equity instrument, preference equity instrument, debentures, mutual, but for short duration, means they have been kept for resale, right. So inventory include other than that, inventory includes raw material, work in process, finished goods, stock in trade, stores and spares, and loose tools, right. So the second item after current assets is that we have to show inventories. Inventory is a very important head and it has many subheads. So loose tools and stores and spares also form part of inventory. So the second is inventory. The third is trade receivables. Trade receivables comprises both debtors and bills payables, right. So we are going to club them together and going to show them as trade receivables, debtors and bills receivables. The third item is cash and its equivalents, which comprises in checks in hand, drafts in hand, cash deposited in the bank. So they all form cash and its equivalents. And the last thing is short term loans and advances given to employees, to anybody else. So that is going to be taken as a separate head in the current assets, and we have to show items in this order. It means current investments followed by inventories, followed by your trade receivables, followed by your cash and equivalents, and then we have short term loans and advances. So with this, the discussion on how to present items is over. Now we shall be taking up a case, and I am going to cover only balance sheet because I know time will not permit to talk about profit and loss account. So we will be discussing a case and where we will learn how to prepare balance sheet under vertical presentation, and in future the very next lecture we shall be covering how to make a vertical presentation of items of profit and loss account, which is now known as statement of profit and loss, right. So let's look at the slide and take this case. This is a case on final accounts in vertical format. We are going to present debit items and credit items, or I may say debit balances and credit balances of certain items have been given in a trial balance. We have been given advances to employees. Second is cash at bank, furniture and fixture. We have premises, patents, patents of 10 lakhs, discount on issue of shares unwritten 25,000. So, we have not written off something. So, this is there as a debit item, which means this is asset. Then we have trade receivables 3,66,240, advance tax 50,000, 8% government bonds 3,36,000, stock in trade 3,55,600. So, total of this side is 76,07,100. Credit balances given are equity share capital 52 lakhs, capital reserve 60,000. Then we have loan from State Bank of India 8 lakhs, provisions for employees welfare fund 6 lakhs is given, proposed dividend is given 1,64,000, short term loan from bank is given 4,90,200, unpaid dividend. Mind you, we discussed this thing that unpaid dividend is to be shown separately, then propose a provision for dividend, right, or proposed dividend. Unpaid dividend 64,800, profit and loss account credit balance means it is profits 42,980, bills payable 85,120 and sundry creditor 1,20,000, right. So, these items are there. So, total is given 76,07,100. So, if we go further, look at the slide, now we shall be talking about solution. So, in the solution, as I said, we need to have 3 columns: particulars, note column and amount column. So, we will follow the same order which we discussed in the format when we discussed the vertical presentation format. All the 4 heads are there: equity and liability section, that is the first section, right. So, shareholders fund is there, share application money pending is there, non-current liabilities and current liabilities. So, the 4 part under the equity and liability section, and then under the assets 2 parts, non-current assets and current assets would be there. So, let us discuss that how did we get the value shown in the amount column. So, as I said, shareholder fund, share capital would be shown separately and reserve and surplus would be shown separately. So, if you look at here in the credit side, credit balances in fact, which is actually liabilities, showing liabilities and capital. So, share capital is given 52 lakhs, and what is the second thing we are showing is we are showing the this amount reserve and surplus. So, where did I get this amount? So, if you look at the question, I would be keep on switching. So, you need to keep a track. Capital reserve and surplus we have to show together. So, reserve is 60,000 and we have profits for the year 42,980. So, if we sum them up together, it should come 1,02,980. So, that should be shown in a note, and that note number should be given note number 1, right. So, that is how we actually deal with items. I am not showing you note because we won't be able to finish this case otherwise, but I have discussed it in length that we need to add up these items and then club them together and show the value under one head, reserve and surplus. There could be many more items, there could be more reserves items or surplus items. The second is share application money pending allotment. In this question, in this case, nothing is given, so we shall be putting the word nil. So, that is how we did it. The third head or rather subhead under equity and liability is non-current liabilities, and we shall be showing borrowings and then provisions, long-term provisions separately. So, under non-current liabilities, let us have a look at what is long-term borrowings and what item is long-term provisions. So, long-term borrowings, we have borrowed loan from State Bank of India 8 lakh. So, this becomes our long-term borrowing, right. So, that is where and how we get 8 lakhs. So, I am switching to the question and then switching to solution slide purposefully, so that you could have a very fair understanding that where are we getting these values from. Okay, so loan from State Bank is given, and then provision for employees welfare fund, and that is 6 lakhs. So that's how these two parts under non-current liabilities. Part 1 under non-current liability is long-term borrowings, part 2 under long-term liability is long-term provisions, 6 lakhs being given, right. So that's how it is going to be taken under non-current liabilities. The next item is current liabilities. So current liabilities are here short-term borrowings. So 4,90,200. So let's have a look, how did we get this short-term borrowings, right. So amount is 4,90,200, and this is the first item under current liabilities. So let's have a look under the items. This is given as it is, short-term loan from bank. Generally a business will take short-term loans to meet up its immediate liabilities or immediate requirement. It could be to pay interest, it could be working capital requirement, it could be simply to buy some inventory or to pay off some creditor. So those are short-term loans generally taken for those purpose, or some specific order is there which is which is not very normal. Generally you get order of, say for example 1,000 items, 1,000 air condition in a week, but in that particular week there was sudden demand from a company, a new business, a new university coming up. So if a new university is coming up, they may come up with new infrastructure and they may order say 100, 200 or 500 air condition altogether for all the departments they are coming up. So in that case a particular company will get suddenly a bulk order and may need to borrow out of its normal record from bank to meet up that requirement, because company need to manufacture air conditioner, right. To manufacture air conditioner, company would need to buy raw material, would need to pay extra to employees, maybe some overtime salaries are going to be paid. So that all forms sudden demand for short term funds. So that is what is going to be shown under this head, and we have been given only one item, so that is short term loan from bank. So 4,90,200 have been taken from this given data. Let's go further. The next item is trade payables, 1,85,120. So where does this money, and there is a note, right. So it's important that we have a look at this item. Where did this money come from? 185,120. So trade payables. So we have been given bills payable 85,120. 100, sorry, it should be 100, and then we have been given sundry creditors 1 lakh, right. So if we club them together, kindly delete either 2 from here or from here. So kindly read 85,100 and then 1,20,000. So sum of these bills payable and sundry creditors together is giving you this value 1,85,120. So this should be shown in the notes, and this total value, because we could have more items. So here it was only 2 items, it was a small case. So all those should be clubbed together and should be shown as a one single value under the amount column, right. The third item is other current liabilities. So under other current liabilities we shall be taking unpaid dividend. So it means this was the amount of dividend which has been announced during the year. It could be, or at the end of the year, so it could be final dividend or it could be interim dividend. But the important point is that it has been announced but has not been paid. So that amount needed to be shown separately, and provision for dividend should be shown separately. I have seen my students committing this mistake, so that's why I am putting emphasis on this particular aspect, right. So this unpaid dividend is shown under the head other current liabilities, and then the last head is short term provisions. Short term provision, the value shown is 1,64,000, and where do I get this money from? Here it is given, proposed dividend, right. So, the proposed dividend is your short term provision. So, by this, if we add up this part, we will get the total of our equity and liability section. So, first part of vertical presentation of balance sheet is over, where we have total of 76,07,100, right. Now, we will begin with the second part, assets, and as we know, assets have two parts, two sub parts. One is non-current assets and another is current assets. So, we shall be referring to the case and then we will be identifying what item should go to non-current assets and what item should go to current assets. That is how you should attempt a question. So, first decide that this particular item is a non-current asset or a current asset. Once you are sure about this is non-current and current, after that the next step you should follow is this, then put them in order, because now we have a requirement to present items as per the given order in the format. So, the format I have already shown and discussed with you. So, so these are the two important steps for anyone to attempt a question in balance sheet, that we should be differentiating between non-current assets and current assets, and thereafter non-current assets should be put in order as desired, as required, and then same should be done for current assets. So, let us follow these two steps for this particular case and learn how to complete or how to solve this case. So, in the non-current assets, the first item, as we know, we should be showing fixed assets, and the fixed assets should be shown in two parts separately, tangible assets and intangible assets. So, there is a note against tangible assets. If you are looking at the solution, the note is that we have been given value 48 lakhs 59,940, right. So, now let us look at the data given. Where do I know, how did we get this value? Advances to employees are not non-current assets, they are advances, they will go to the second part. Cash at bank is a current asset, of course. Premises are non-current, of course. Patents are intangible, right. Discount on issue of share is not a fixed asset. Trade receivables are, of course, not fixed assets. Advance tax is not there. So, government bonds are of course they are under the right. So, government bonds are there, and then stock in trade is there. So, we have to take only tangible asset and then separately intangible assets, 10 lakhs would be shown separately. So, other non-current assets are there, and then in the current assets we shall be showing current investment, inventories, trade receivables, cash and equivalents, short term loans and advances, and other current assets. It means what is left. Now, you should be able to look at that how did we get 48 lakhs 99,940. So, we have been given this premises 41 lakh 9,940, and this furniture and fixture 7 lakh 50,000 is given. So, if you sum them up together, you will get 48 lakhs 59,940. So, it is very important to understand that, and remember, in fact, we need to memorize that what would constitute as total tangible asset. So, I can't help you because you would have to memorize it, but I can explain for sure, and this presentation would help you to understand. But nevertheless, this is your responsibility to memorize what all items should be summed up together, because here I showed you all the items. So, furniture and premises were the two items in this case which we identified to be clubbed, and so with this clubbing part, this adding up part should be done in the notes, right. So, that is how we get this value. Now, intangible assets are given clearly and separately, and there is only one intangible assets. 10 lakhs. So that's how this value 10 lakhs comes from. But I hope you remember in the discussion, in the explanation, I have shown you about 15-16 items which could fall under intangible assets. It could be patents, it could be formula, it could be recipe. You know, many we have many brands, international and national brands, which have different franchises, which have different outlets across the country, across the world. But even then we find the same taste in French fries, same taste in burger. How come? Because the recipe has been shared with all the people whom the franchises rights have been given. So you will find the same burger in United States. If one brand, you know, you have eaten in US and you have eaten in India, you will find the taste is same. And that is possible because recipe has been given as a right. A recipe has been shared, and that becomes an asset for the company. And then of course in this case we have other non-current assets, 25,000. Current assets are current investment, so no calculation required as it is been given. Inventories are given as it is, 3,55,600, so we have taken up. Trade receivables are given as it is, 366,240, so no discussion required. Cash and its equivalents are given as it is, so 3,14,320 been taken. Short term loans and advances of 3 lakhs have been taken from the question, and the last item is other current assets, which is 50,000, right? So that has been taken. So if we sum up together, the total would be same as was in liabilities and equity section. So by this our two sides matches, which is assets and the equity and liability side, though I am using the word side because I am used to, but the fact of matter is this particular vertical presentation do not have two sides. Everything is in running. As I said, it's difficult to unlearn because I am used to say this word. So so this is the same problem you may face. As I said, if you have already learnt the horizontal presentation, if you are a grad student and in your undergrad you have learned horizontal presentation, you would really find little hard to adopt this vertical presentation, so which would require a little extra effort on your end to practice and learn it. So I hope you were able to understand how to present vertical format or presentation of items in balance sheet. So thank you very much viewers for watching this show for 1 hour. Thank you.
With this note, thank you ma'am, thank you for your deep inputs to the lecture. Friends, you are requested to write to us at info.cec@nic.in. This is the ID where you can give your feedbacks as well as your questions too. We'll try to give answers to your questions when next time Dr. Amarjit Kaur visits our studio. Today we are taking your leave with the promise that we are going to meet again soon. Till then, take care. Goodbye. Thank you ma'am. Thank you.
Thank you, Kritika.